Reliance Q4 FY13 results were in line with our expectations, especially on the profit front. And they announced profit of around 5,590 crores, which was in line with our expectations. However, on the revenue front, they were below our expectations, and this can be attributed to the fact that the refinery was shut down for a particular period during the month of Feb, and that caused lower throughput. Coming to operating margins were slightly better than our expectation, mainly on back of better refining segment performance. The segment-wise performance, if we go through, the refining segment is where the company outperformed in terms of EBIT margins. While GRMs were in line with our expectations, we were expecting it to be around $10 per barrel, and they delivered $10.1 per barrel. But the operating margins were better than our expectations. However, on the petrochemical side, the EBIT margins were at 8.6% compared to our expectations of around 9%. This is mainly on account of some pressure witnessed on the polyester chain. And on the E&P side, again, there was a disappointment with EBIT margins coming at 28% as compared to our expectations of around 30%. And even the volumes were slightly below our expectations of the KG-D6 gas. So in that net petrochemical was slightly negative, and so was the E&P, but the refining segment outperformed our expectation, and resulting in a slightly better than expected operating margins. However, other income was substantially ahead of our expectation, resulting in inline profit growth, and the other income was now contributes to around more than 30% of the PBT, which is slightly taken negative by the streets because the quality of the earnings seems to be deteriorating. However, the company is now investing its 80,000 crore worth of cash into its projects on petrochemicals as well as the refining segments, and even in the E&P side. So going down the road, this contribution of other income to the PBT is expected to reduce. The key from the consolidated results, there were a couple of positives to be taken away. The first one being the fact that the retail business has turned around, and that is something which the streets have been waiting for a pretty long period of time. Second point that was positive from the consolidated results was the increasing contribution of shale gas to the profitability, and that is likely to extend with the continued volume ramp up from the shale gas fields. Going ahead, the outlook for GRMs is slightly muted. In fact, GRMs have slightly fallen from the previous quarters, and so is the petrochemical spreads are also expected to reduce. In that terms, I think so. The FY14 doesn't look great for Reliance Industries, and but FY15 could be a great year where the company could see better refining margins, better petrochemical spreads, higher petrochemical production because new plants commence operations, and thirdly, the E&P business could also see better earnings mainly on back of higher gas prices. So in that terms, FY15 is the year to look forward to, and even for that matter, FY14 will be a full year of a lot of events and news for Reliance Industries, especially around the E&P and the telecom spectrum. In that terms, I think so that it's going to be a news-driven year, and lots of positive news can be expected for Reliance. We are upgrading the stock to buy from our previous market performer rating. Thank you.